Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward.
And today we are diving into Oracle Corporation, ORCL.
And what a dive it is. Let's lay out the thesis right up front because it is a wild one.
Okay, let's unpack this. So Oracle is executing what you can only call a high-stakes industrial metamorphosis.
The metamorphosis, yeah.
They're going from, what was basically a slow-growing enterprise software utility to a hyper-growth AI infrastructure provider.
And the evidence for that is just a staggering number.
It is a record $523 billion backlog. But, and this is the whole story, it comes despite a devastating liquidity swing. They went from plus $11.2 billion in free cash flow to negative $13.2 billion.
Which is 6 quarters. That's
Right.
That's the tension right there, isn't it? The whole story is in those two numbers.
That's the entire conflict.
That thesis really does set the stage. When you say software utility, I think of that steady, almost boring subscription revenue.
Predictable.
Exactly. And now it sounds like they are trading all of that stability for this high-risk, high-reward growth.
They are fundamentally changing what they are. I mean, the new business model is essentially that of a utility provider for the AI boom.
Like a power grid for AI.
A massive global power grid for computing.
Yeah.
And that shift changes everything about their operational focus.
So if they're a utility, they're not worrying as much about where the next customer is coming from.
Well, according to management, no. This is a critical insight from the sources. Oracle views the company as, and this is a direct quote, supply constrained, not demand constrained.
Well, okay, hold on. So you just unpack that for a second. That means they believe demand is practically limitless.
That's the bet. The only bottleneck, the only thing holding them back is how fast and how profitably they can build out the physical supply, the data centers, the power, the chips.
And that's where it gets really interesting, because if you believe that, you have to shift your entire corporate culture, right? From sales-led to
an engineering-led culture, a builder's culture, and you see it right at the top.
the CEO promotions.
Exactly. They promoted Clay McGork, who runs infrastructure, and Mike Cecilia from the application side to CEO roles. This isn't just shuffling titles. It signals they're prioritizing the technical build-out above all else.
The builders are running the show now.
Yeah.
Okay, so what about the raw materials for this build? We all know GPUs are the new oil. What's Oracle's strategy there?
They're pursuing what they call chip neutrality. It's basically a risk mitigation strategy.
So they're not all in on one supplier.
Right. They have a very strong relationship with NVIDIA, you have to, but they're also actively forging a partnership with AMD.
Diversifying the supply chain.
It's a crucial move. They recognize the danger of relying on a single vendor in this kind of market.
Okay, strategy's locked. Leadership is in place. Let's talk about the fuel for this whole thing. That incredible backlog number, the RPO.
Right, so RPO, remaining performance obligations, it's basically the amount of money customers have signed contracts to pay Oracle in the future. It's booked revenue.
And that number is?
It's a record. $523.3 billion.
That number is the size of a national economy. It's hard to even process.
And get this, it's grown an astounding 433%. year over year.
That's unbelievable. But this is the core conflict, right? This is the investment curve trap.
Yeah.
You have that massive growth booked, but you have to spend a fortune now to deliver on it.
That is the trap. Precisely. Yeah. To service that $500 billion backlog, they have to build the infrastructure first. So they raise their FY26 Capex guidance.
Capital expenditure, yeah, the spending on physical assets.
By a shocking $15 billion in a single period.
And now they're looking at a total of what, $50 billion?
Approximately $50 billion over the next few years.
Yes. And that just incinerates cash flow.
It does. It's why their free cash flow registered a negative $10 billion in Q2 fiscal 26 alone. They're literally pouring cash out the door to build the infrastructure to service that future revenue.
It's the ultimate build it and they will pay strategy. But it really begs the question, who exactly is going to pay? Who's writing these massive checks?
Correct. And this is probably the single greatest risk in the whole thesis. The sources indicate that this growth is dangerously concentrated.
How concentrated?
Well, external reports suggest that approximately $300 billion of that backlog,
$300 billion out of 523,
is tied to a single critical customer, OpenAI.
Wait, $300 billion from one customer?
Yes.
That's not just a big bet. That's the entire casino. The counterparty risk there is immense,
It is, especially when you look at the speculation around OpenAI's own burn rate.
which is what are the sources saying?
They raise a pretty frightening possibility that OpenAI internally projects $500 billion in operating losses by 2030.
$500 billion in losses. So Oracle could just be left holding the bag.
The ultimate bag holder. If AI demand slows or something shifts, Oracle is left with all the specialized capacity that isn't getting paid for.
So what's the defense? I mean, how does management justify that kind of risk?
Their defense centers on one word: fungible. They argue the physical capacity they're building is fungible.
Meaning they can just swap in a new customer if one defaults.
That's the claim, that if a client defaults, the underlying resources, the GPUs, the power, can be repurposed and reallocated to a new customer in a matter of hours.
Okay, but hold on. The hardware might be fungible. I get that.
Okay.
But a $300 billion contract isn't. You don't just find a new customer to fill that kind of hole in a few hours. That seems wildly optimistic.
And that's the critical challenge that the sources highlight but don't resolve. You're right, the physical asset is fungible, perhaps. The revenue stream is not.
The risk isn't the building falling down. The risk is the building sitting empty.
Exactly.
Let's pivot for a minute. We've been heavy on the infrastructure, the hardware. But Oracle's traditional strength is applications,
Yes.
software. How are they building a moat there?
Well, they're moving beyond just being best-of-breed SaaS. The strategy now is about embedding AI agents directly into enterprise workflows.
Making AI a feature, not a separate product.
Right. You see it in healthcare, where their clinical AI agent already has 274 customers live. And their core Fusion apps, like ERP, are seeing double-digit growth. The AI integration is clearly driving that.
And what's the long-term technological moat?
Yeah.
The thing that ties the hardware and the software together.
It's data sovereignty. This is their ultimate defense. They're positioning their AI database as the secure repository for all private enterprise data,
So companies can use models like ChatGPT for reasoning.
without ever exposing their own proprietary data. The data stays locked in the Oracle ecosystem. It's a huge selling point.
And this AI database, it isn't just limited to their own cloud, is it?
Absolutely not. And that's critical. The multi-cloud expansion is key. They are physically placing Oracle database hardware inside Amazon, Google, and Azure data centers.
So they're going to where the customers already are.
Exactly. And it's working. Their multi-cloud database business grew over 1,500%. It's the key to unlocking all their customers' fragmented data.
This really has been a deep dive into an all-or-nothing moment for a tech giant. I mean, they're forecasting staggering success, targeting $225 billion in revenue and $21 in EPS by 2030.
But achieving that means navigating these extraordinary risks right now.
So what's the final picture?
Look, if we connect it all, the profitable conversion of that massive backlog into real cash flow will either confirm Oracle as the true power grid of the AI economy, or it'll expose these huge vulnerabilities they've taken.
Because they've taken on a lot of debt to fund this, right?
$18 billion in new debt. So you combine that with this extreme reliance on a primary customer facing potential solvency risk. It really suggests the stock right now is a highly leveraged binary bet on the future of the AI hype cycle.
A high-stakes gamble built on silicon and software. Thank you for walking us through this. It's a truly unprecedented risk profile.
Risk defined, portfolio protected.